You know that feeling, right? That stomach-dropping moment when you log into your account and a stock you own has just tanked overnight. Your first thought is probably, oh no, disaster. But what if it wasn't a disaster at all? What if it was something totally planned, totally structured, and honestly, not nearly as scary as it looks? So let's imagine this exact scenario. Your stock was trading at a solid 10 shekels. You check it today, and suddenly it's at 8. That's a 20% drop. I mean, the natural reaction is to panic. But what if that's completely the wrong reaction? Let's dig in and find out what's really going on here. So the culprit here isn't some bad news or the whole market freaking out. Nope. It's actually a planned event started by the company itself. It's their way of raising a bit of money by offering a special deal to their most loyal fans, which of course is you, their current shareholders. Okay, so what exactly is this new thing that just sort of appeared in your account called a right? This isn't just some random detail, it is the absolute key to unlocking this entire mystery of why your stock price fell. Let's break it down. The best way to think of a stock right is like an exclusive time-sensitive coupon, and it's only given to current shareholders, like you. It gives you the privilege, but hey, not the obligation, to buy more shares of the company directly from them at a pretty significant discount. And here's what makes this coupon so interesting. It's not just for you. It's actually a tradable asset. So you've got two clear choices. You can either use it yourself to snag more stock on the cheap, or you can sell that right to another investor for cold, hard cash. All right, so how does any of this explain that price drop from 10 shekels down to 8? Well, the answer isn't about feelings or bad news. It's just pure, simple math. So here are the two numbers we need for our example. First, you owned one share, and it was trading on the market for 10 shekels. Then the company gives you a right, letting you buy one brand new share for just 6 shekels. I mean, that's a pretty nice discount. And you know what? The market is incredibly fast at this. It instantly figures out the new total value. Your original 10 shekel share, plus the new 6 shekel share you can buy, adds up to a total value of 16. But that 16 shekels now represents 2 shares. So the market just divides by 2, and bam, the new stable price for each share becomes 8 shekels. So yeah, on paper, your original share did lose 2 shekels in value. And if that's all that happened, you would have lost money. But that is only half the story, because in exchange for that little price drop, the company handed you a brand new asset. And this brings you to a crossroads. You're holding your original share, which is now worth 8 shekels, and you're also holding this new right. Now you've got a decision to make. What do you do with it? Your decision really comes down to 2 simple paths. Option A is you exercise the right. You use your coupon to buy that cheap stock for yourself. Option B is you sell that coupon to someone else who wants in on the deal. Okay, so if you go with option A, you send 6 shekels to the company, and they send you 1 new share. Now you own 2 shares, and their total value is 16 shekels, or 8 shekels per share, which perfectly matches the new market price. You've basically kept your position's value intact by investing a little bit more. Now, let's look at option B. Maybe you don't want to buy more stock right now. That's fine. You can just sell your right on the open market. Another investor will pay you cash for it. So now you're left with your original share worth 8 shekels, plus the cash you just got. And that cash, well, it should make up for that 2 shekel drop. Okay, but this whole thing really hinges on one big question. How much is that right actually worth? Like, how much cash can you really expect to get if you decide to sell it? Let's figure it out. The logic here is pretty simple. Your total net worth shouldn't change just because of this move by the company. Before all this started, your total value was easy. 1 share worth 10 shekels. Afterwards, you have 1 share worth 8 shekels, plus this one right of, well, we don't know the value. But for your total wealth to stay at 10 shekels, the math is just unavoidable. And there it is. There's our answer. To keep the whole equation perfectly balanced, that right has to be worth exactly 2 shekels. It's literally the only number that works. Your 8 shekel stock plus this new 2 shekel right gets you right back to the 10 shekels you started with. You're whole. Nothing's been lost. And this just brilliantly illustrates the whole point. Those 2 shekels of value didn't just vanish into thin air. They were transferred. The value moved from one of your assets, your stock, over to another one of your assets, your right. Your total wealth is identical. It's just been split between 2 different things. Now, you might be thinking, okay, this all sounds great in theory, but would someone really pay me 2 shekels for this thing? Fair question. Let's prove it by looking at the deal from the buyer's side.
So a new investor comes along and they want to buy into this company. They see your right for sale, they pay you your 2 shekels for it. Then they turn around and pay the company 6 shekels to use that right and get a share. So what was their total cost to get that share? Well, 2 plus 6 equals 8 shekels. They end up paying exactly the fair market price.
And this is what creates a perfect fair market. That 2 shekel price for the right is the great equalizer. It's fair to you, the seller, because you get your money back from the stock drop. And it's fair to the buyer, because their all-in cost is exactly the new market price. See? The system works? So let's just quickly put all the pieces together. That initial scary-looking price drop, it wasn't a loss at all. It was just a simple transfer of value into a new thing you own called a right. And you, the shareholder, are completely in control. You can either use that right to buy more or just sell it for cash, keeping your total investment value perfectly stable the whole time. So, the next time you see a sudden drop in one of your stocks, your first reaction won't be that jolt of panic. Instead, it'll be a simple question. Hey, was there a rights offering? When you're armed with this knowledge, you can approach these situations with clarity instead of anxiety, which makes you a calmer and ultimately a much smarter investor.